Hi, everyone. We're just going to give people a couple more minutes to funnel in. We're a little bit early. There are a bunch of keeners who are on about 5 minutes early, so thank you. We're going to give it a couple of minutes before we kick things off.
In the meantime, though, we love getting the chat going, and I'm sure there will be a lot of, or I hope a lot of activity in the chat today. Let us know where you're joining from. We've seen a lot of people from kind of all over the world in the last few webinars, but let us know where you're dialing in from, and we'll get the chat going. We'll get started here in just a minute.
This is definitely a hot topic. We have over 200 right now, and it's still piling in. So we knew it was going to be a hot topic. This just shows us that we were right.
All right, shall we?
Yeah, we shall. We're going to start slowly because there are still people coming in. Welcome and thank you to coming to today's webinar. We know and we heard from all of you that you wanted this topic presented, and we're going to be here to present it to you. For those who have missed it and weren't able to come, you will be receiving a recording of today, so feel free to share it with anybody who did miss it, and we will post it online as well. As Adam mentioned, please do type in any questions that you have into the chat box. We know it's a hot topic. We know that it can often be a controversial topic with multiple opinions. Let's keep the conversation friendly, but let's keep the conversation going. So please do, as we go through, type in your questions and we will try to answer them as we present, not wait until the end so that it can fit in nicely with the conversation. Dovetailing nicely into this and this topic, once we're kind of completed, you'll see what we're speaking about, and it will be brought to life a little bit more. But on our website is the 100 or top 100 most valuable properties where we valued each with our sponsor pulse opportunity value. So that will make more sense as we go through this, but please do know that that's online, ready to go, ready to be viewed. With that said, I'm going to pass the mic to my colleague Adam Mitchell, who's going to kick us off.
Thank you. And thank you everybody for joining us today. Valuation is such an interesting and challenging topic for, I think, a lot of reasons that we all know. But reflecting as we were kind of putting this presentation together, and as we were talking about how do we do this in a way that's going to be fair to all parties, one of the things that I was reminded of was one of my first experiences property side, and I won't say where or with whom, where we were on a call negotiating a deal, talking numbers on the deal. There were three of us in, a boardroom. We one of the individuals in the boardroom that I was with put the conversation on hold, and the conversation that we had internally was how much more can we get out of them? Like that was the question that was posed. It wasn't about how much value we were going to deliver. It wasn't about what the brand in this particular instance needed necessarily. It was how much more can we get? And I think that's like a really interesting frame of mind. I'm not suggesting that that's the wrong frame of mind, but I do think that there are some flaws to it. And I think that we're going to talk about that today. I say that because I've been the property side asking for more. I've been the brand side asking for a lower price, and now we're kind of sitting in the middle. We're going to talk about some of the traps. We're going to talk about, our approach and show you essentially behind the curtain of how we go about valuation. But we're not at all sitting here saying that we've got it all figured out. I think that this is a hot topic for a good reason because there's a growing industry that we're all part of. And the amount of spend that's flowing in is increasing, but especially in turbulent or challenging and uncertain times that we're living through, there's a lot more questions about are we spending the right amount of money? But we're going to dig into that. So what's kind of like the kind of premise? We all talk about like the black box of valuation. So like what are we trying to accomplish? We're trying to open up a conversation. There are very few conversations out there about valuation. And I think if you look back, my experience at least, and I think many people that we work with today would agree, is that valuation has lacked transparency, lacked credibility, lacked rationale. It's kind of like, here's a price. This is what it is, and this is what we think we can get, and this is what we can get out of the market. So this is what we're asking for. But that's not the way that the world operates, certainly not anymore, or certainly less and less. And we've seen some progress, but there's a lot of room for growth. So that's why we're here today, why we're having the conversation that we're about to have. We're also having it because, frankly, you've all told us that you want it. In some of the surveys that we've done after previous webinars, we've heard loud and clear that sponsor evaluation and our approach or an approach is something that people want. So we're here. So before we get into it, a quick reminder, we are eyes wide open. We know that by doing this, we are essentially becoming a punching bag for brands, properties, and agencies, and that's fine. We actually encourage it, respectfully, hopefully, but like we know that we're all not necessarily going to agree on everything that we do or our approach. That's fine. Challenge us, ask us tough questions. Like we're here for it. That's how we get better. But the thing that we need to remind ourselves is that yes, there is a silver bullet, so to speak, in the world of beer, but there's no silver bullet for valuations. There are, I don't know how many, but there's hundreds of people that have joined or have registered for this webinar today. I'm sure there's probably at least a couple dozen different agencies with different valuation methodologies, and they're all worth looking under the hood and investigating, right? So we encourage you to do that, and you can use this as kind of a jumping off point for that conversation. So we're going to talk really quickly about 8 traps that we see on almost a daily basis in the world of valuation and sponsorships. Some of these hopefully will resonate. As I said, we're not saying if you're doing any of these things that they're wrong. We're just giving you food for thought. These are things that we're hearing on an ongoing basis. And then we'll dive right into the way that we approach sponsorship valuation. But as I said, questions are open, chat's open, so please jump in. So what's the number one thing? Value banks. We hear about value banks literally every single day, and it is almost painful. They serve an amazing purpose when they're done properly, right? The world changes. Deals that are 10 years old, I mean, there are a lot of social platforms that weren't even around 10 years ago. So how do you give yourself flexibility to be adaptable year over year and to improve and to do more of what works, more of or less of what doesn't? The challenge that we see with value banks, though, is that there are these large and growing sums of money that have literally no commitments associated with them. It's kind of a mutually agreed upon. It's very loosely defined, very loosely tracked often, not always, but they can serve a great purpose, but they're causing a lot of headaches. And there are some parameters that probably would help in ensuring that they're treated well and that they're to the benefit of course, the sponsor or the brand that's agreeing to spend the money. So keep an eye on value banks, find a right way to set them up. IP rights. We hear this all the time. We have a different methodology, which you'll see momentarily, but IP rights traditionally are like a line item that you see on a deal. IP rights, $2 million, IP rights, $5 million, whatever it may be. And it's access so that you can use the marks, use the logos, so on and so forth. Our belief is that IP rights and the value of the property, its fan base, its ability to generate obviously interest and deliver outcomes for brands, that's all part of the story of justifying why you're in the sponsorship. And there's absolutely a difference between, top performing teams and some of the bottom performing teams or properties, be it in sport, music, or otherwise. But the idea that you can literally have a line item on a contract that says IP rights with a large number next to it and not actually back into it or provide any true tangible value is a dangerous thing that we're seeing start to exit a lot of deals. So keep an eye out on IP rights, and we'll come back to this in a moment. What are you actually selling? Naming rights. Is it naming rights? Is it presenting rights? Is it presented by rights and partnership rights? We don't know. And oftentimes it changes, but going to market and ensuring that you're understanding what you're offering is going to obviously help. And there's different value, right? The ability to name something is different than being a partner of. So how do you account for that in valuation? How do you as a property, if you're exploring some of these different opportunities, how do you look at these and build a business case internally to suggest or to recommend that we should be looking for a naming rights partner? Or perhaps we say we shouldn't, and we're happy with what we think we can get out of a presenting partnership. There are differences along the scale, so it's wise to prepare and to value those things accordingly so that you're ready to make those calls. There's a lot of properties that have the church and state challenge, right? You don't necessarily want to give naming rights away to your property, but if you can quantify the benefit, it makes it a lot easier to have that conversation to figure out how you want to go to market. Charging based on what you think you can get instead of the value you're delivering. This is exactly the life experience that I had, and I'm sure I'm not the only one. But the focus of today and the focus of valuation conversations needs to be about what value you're providing to the other party, not about what you think you can get out of the category based off of the latest deal that you saw in the news or based off of what you think you can get out of the category. It's a really difficult way to approach partnerships and valuation. So focus on the value that you're delivering, not what you think you can get out of it. Arbitrary year-over-year escalators. We see this all the time. There is a growing trend, though, which I think is very positive, where we're seeing more and more performance-based thresholds. So yes, we know life gets more expensive. Yes, we know there's inflation. That's true. It's a reality that we all live with, not just in sponsorship. However, if you can build in performance-based kickers that allow you to essentially unlock those escalators, it's a much more positive way of looking at a deal's growth over time, or at least having part of that escalator tied to performance-based metrics that the property is then incentivized to achieve to ensure that they're continuing to deliver more value as they're getting more value out of you, the brand or the sponsor in this particular case. Next up, I don't know where it started. I don't know why necessarily, but somebody somewhere decided that there was like a 3-to-1 or a 4-to-1 or a 5-to-1 value that we should all be shooting for. And that's great, I guess. But it also has caused so many headaches for this industry. Why would anybody give you $3 for $1? I don't understand the logic there. I think what's happened is that we've seen a lot of data out there that actually is probably inflated in terms of the value that's being provided from exposure, from whatever may have you. The challenge is that rights holders were all of a sudden held to this 3-to-1 kind of rule. And I'm not suggesting that rights holders or properties are the ones that created it, but this is troubling. Why would anybody give you $3 for the price of one? It just doesn't make sense. So how do we build a better system to understand what the value exchange is? And we have a proposition, a proposal, and what we use as what we think the right benchmark is that we'll talk about in just another way. 300 billion impressions. How many people have heard this in a post report? We hear it all the time. We see it all the time. I'm not suggesting that it's not true. I'm not suggesting that some of these earned media, trackers aren't accurate. But if you literally just play out the logic of that with a $10 CPM, just for sake of argument, that's 300 or $30 million in value. And like there is a bit of a credibility question that comes into play. And is earned media actually delivering the same value as a more strategic approach or a more committed approach? So be careful when you're talking about the number of impressions that have been delivered. And lastly, the last trap that we see is this like no guarantees. We're valuing and we're asking for millions of dollars out of the market. We're offering you exposure and visibility, but there's no guarantees, no commitments in the deals. And that becomes very difficult because if you're looking at your opportunities that exist within sponsorship versus media, in the world of media, most publishers will guarantee you at 90% or greater at this point in time. So knowing what you're up against, what you're being compared against is helpful to ensure that we're not falling into that trap and, leaving all these assets itemized and not committing to tangible deliverables, which obviously makes it a lot easier in post. So some of the traps, I've fallen into literally every single one of these traps. So we're not saying that we know it best. We're just saying these are the things that we see, that we hear, that we're talking about on a day-to-day basis. And hopefully this gives a bit more food for thought on things to watch out for. But I'll throw it to Neil to talk about actually how we approach art and science in the world of valuation.
Okay, thank you, Adam. We can't see anybody, but I'm sure by now, if we could, we would have seen nodding heads as well as grinding teeth. So again, please, as we continue to go through this, if there's anything that is said that we want to discuss or even debate, type it in and we will stop and we will have that conversation as we go. For now, we're going to step back. Adam has mentioned a lot of the pitfalls. He's given you a scenario that he was in. So how do we help mitigate the noise and create that common currency that all of us can get behind and use? Well, we're going to take you through it. And at the end of the day, we're going to show you our phased approach. But the nucleus to everything we do is people. Okay, it's consumers. So yes, we use and interpret media value, equivalency, transparency, those types of things with impression-based data, but everything comes back to people in the funnel of things. So after an impression is served, what's happening with somebody in relation to, are they recognizing the brand and knowing and being aware of the partnership all the way through to, are they purchasing more as a result? That's how we quantify value, starting with our opportunity value. So when we get into things, it starts at, again, a sizing of the prize, passion point, opportunity. The very first thing we do, again, speaking to people, is understand how passionate they are towards the property or the opportunity, as well as would a partnership with the opportunity impact them to be more likely to purchase. Okay, so everything starts with and funnels down into a number of people perspective From there, we start to value. We start with our opportunity value, which is a top-down approach. So before we get into valuing all of the assets and what each asset is worth, and Adam's going to take you through that and the approach for each asset and how we quantify the value in just a second. But before we do that, we create guardrails that are even and transparent across all properties. It doesn't matter if it's a sport, it's the league, if it's a team, if it's a music event, if it's a festival, if it's an award show, if it's a cause. Again, because it all comes down to people, people being reached and people being impacted, we have a standard and common ruler. So we can create a value for each opportunity that sets guardrails for what we would recommend fair market value be for a brand to spend against the opportunity. It isn't an inflated number that we use. It isn't something that you have to discount after we've shown it to you. It's again, based on our representation, fair market value for what something's worth based on a number of factors. And we'll get into what those factors are in just a second. And then the last thing that we do is value from a bottom-up approach all of the assets that are being proposed. Okay. So often we've seen the asset list and the value of the asset perhaps surpass that of the opportunity value. And that is possible. Not something necessarily we would recommend spending against because we've given those guardrails, but that's why we then look at and last look at the asset package and asset mix. Okay. Mr. Mitchell, any questions so far from anybody, or they just want to see the numbers?
Good. I mean, most people are just saying, wouldn't it be nice if we could have transparency and integrity in what we charge, which we certainly agree with. So hopefully, this approach is one that hopefully gets us closer to that mark.
Yeah. And we're going to take you through the how to. So, we're going to be very transparent right from the get-go. And you're going to see our approach and you're going to see exactly how we do things, starting again with the opportunity value, but before that, property health. And we are going to use our case study example of the Charlotte Hornets to do so. Okay. We start by sizing the property. So on our platform, all of this I actually should step back and talk about. All of the data that we're about to show you right now, as I speak, comes from our platform. And we'll talk a little bit more about that in just a second. But essentially, what our platform is a survey with thousands and thousands and thousands of people on thousands and thousands and thousands of passion points. Passion points being properties, music, cause, culture, entertainment, sport, lifestyle, etc. We don't just ask somebody whether or not they're a fan. We ask somebody whether or not they're a fan, and then we start to dive deep into the meaning of that fan base. So the quality of that fan base, all the way through to would you be impacted by a brand that sponsors or is associated with the particular property. Okay, so those are the metrics we use and the starting point for how we declare an opportunity value of something, again, which is a fair market value. So in the Hornets example and at a state level, we know based on our surveys that so we start with breadth, reach of the Hornets is 3.4 million people. Okay, so 46% of consumers aged 13 to 64 in North Carolina are fans or engaged with the Charlotte Hornets. That's our starting point. So you can see how quickly a million, 10 million number, impression-based number becomes a 3.4 million actual people number, okay? Which again is our starting point. The next thing that we do to qualify a sponsorship and an opportunity value is we look at the trend, okay, and the momentum of that property. And we're going to talk a little bit more about on-field, on-ice, on-pitch performance. It does matter, okay? We can tell you we're about to do a blog on that as well, so you'll see that shortly, but it does matter. And it does impact sponsorship results. Not always. There's exceptions to every rule, but on average, it can limit you or it can amplify you, okay? So we look at again, the momentum of a property and how well they're doing from a fan base perspective. So you can see here that if a brand came to us and said, we're thinking about the Charlotte Hornets, first thing we would tell them is 3.4 million people. Next thing we would say, and from a reach perspective, growing. Okay. Then there's context. So often what you will probably be thinking right now is, well, I don't know, is that number good, bad, indifferent? Here's the context to what that number is in that local market relative to other like type properties. And again, you can compare it to music festivals, events, causes, culture, anything that you want on that marketplace. Here, by way of an example, we're comparing it to other sports properties. So you can see the Hornets is kind of in the middle of the pack of opportunities within North Carolina. Okay. Then we get to, I promise I'm not going to take you through numbers of every single funnel metric, but I'm going to take you through the ones that are really going to matter right now to the opportunity value. And in addition to the reach and the size of the team, for example, is the potential the team has to drive sponsorship impact, to drive more people to want to buy a brand that's associated with it. So that 3.4 number, I think it was 3.4 number, million number ahead that we talked to from a reach perspective very quickly turned into just under 500,000 people who say, I'm a fan of the team and I would be likely to buy a brand that associated with the team. Okay, and I promise you that all of these numbers are going to come into storytell behind a value in just a second.
One
We
sec,
then
Neil,
com
if you don't mind, sir, we just got a quick question about how we size. So how do we define engagement? And then how do we size the property and purchase consideration accordingly? So how do we move down that funnel?
Okay, these are the questions we love. So, first of all, when we define engagement, it isn't a hand raiser question, meaning we're not asking whether or not you consider yourself to be a fan, because when you do that, it's overstated. So it very much is behavioral based. We ask you whether or not in the past 12 months or in the past season, you followed the team in any one of, I think it's 8 different ways. So you could have bet on them, you could have watched on television, you could have attended the event, talked about those sort of things. So engagement is behaviorally based. For a cause, we don't ask whether or not, obviously, somebody has bet on the cause, but we do ask whether or not they volunteered time or donated money. That's how we get at an engagement number. From there, we use census data and population data to size that out. If there's 1 million people in the general population and 50% of them are engaged, that's 500,000 people. From there, we size down into impacted. We ask whether or not you would be more likely to buy a brand as a result of the partnership to fans, to those people who are engaged. We get a percentage of that and we size it back to the population. Hopefully that makes sense. I can't see the comments, but hopefully the person who asked gives a thumbs up.
Keep rolling. There's some good questions, but we're going to come back to some of these points in a minute. So we are not ignoring
Okay.
them. We'll get there.
So that starts with sizing, but the next thing that we need to look at is quality of the audience in addition to, again, bottom of the funnel purchase consideration. Are they the right audience for your brand? Because that's going to matter based on value and how much you could or should spend. We start demographically. Again, this is live data for the Hornets and who their fan base is. I'm going to continue on because I know that there's a lot of questions and discussions, but then we get into the category. So here are categories, both short-term and long-term purchasing, that over-index and are overrepresented based on their impact potential. Okay, so we have 1.4 million fans who purchase from a pizza restaurant, so on and so forth. So if you're a pizza restaurant brand, your universe of people isn't necessarily, again, all 3.4 million people. It's the percent who purchase in your category, unless we're trying to grow the category. But this is a good starting point. And then there are categories that they might have higher ticket purchase item price tags, but they have less people who we're going to be able to connect with, which also has to be factored in to value and opportunity value and decision making when it comes to sponsorship value. So here are the numbers for the Charlotte Hornets. Okay. To start, we use all of the data that we just talked about, category level, engagement, reach, impact, those types of things. Then we layer in our database of thousands of case studies that we have from industry benchmarks. What we do and how we layer it in is to first size the opportunity. There's a difference between a tier one, tier two, tier three, or even tier four partnership. How we identify whether or not something is at that stage is based again on our action standards of what we've seen awareness be in each of those instances. Then we assign market values to each of those metrics based again on our action standards and what we know a cost-effective spend is when we perform that analysis from an impact report or from an actual evaluation. So getting to the numbers, because I think we all just want to get there. I'm going to build out my fancy animatics. We start with, again, that top bucket, which is number of people. We start to size the opportunity. We give credit to momentum. okay, and look at where things can be in 3 years based on the momentum that the team or the league or the event is seeing right now. So we get to a number of people perspective. Then we start to model out scenarios starting based on awareness and expected awareness of a top tier partnership within each of those tiers, and then impact, which again we've asked about earlier, which all equate to, again, a number of people, and then we value each person based on our industry action standards. So based on this, we are saying for a tier one sponsorship, the Charlotte Hornets should be worth on average about $1.3 million, all the way down to $645,000 for a tier three partnership. Whether or not you say you're bang on or you're way off, you can use the calculation from a consistency perspective to model other opportunities in the region or at your disposal in the exact same way so that we can start to look at variance between. So the Hornets is in the middle of the pack from a fandom perspective, started to edge towards the kind of more bottom half from an impact perspective. Their value for tier one is 1.2 million. When you look at the Carolina Panthers, it's 2.8 million. And you can start to create and compare opportunities and what you can expect to spend based on the opportunity value, which is based on the number of people you can expect to impact and reach. I'm going to stop for a second because Mitchell looks like he's itching to ask questions.
Oh,
Not you personally, but
there's a good banter going on in the chat, and I love it. I think it's great. Like we're getting different perspectives on like what is what. I think like the reality is that what we've done so far and what Neil's walked through is essentially the health of the Charlotte Hornets relative to everything else in the market that we're currently exploring in North Carolina. We've been able to quantify that fan base, quantify those within that fan base that are likely to be impacted by sponsorship. And then we've used those metrics. We've used consumer metrics and then benchmarks that we have from measuring, obviously, hundreds now, thousands probably of sponsorships over the last several years to build this model that is entirely rooted in data. It is transparent to the sense that Neil literally walked through every single line item, line by line, of what is input into that model to get at what is the value. The thing that we have not done yet is we have not talked about assets. And that's intentional because, as Neil pointed out earlier, it's easy for a lot of properties to add and add and add and add and add assets to make a package worth $10 million or $20 million. But does that mean that the property actually should or the brand should spend $10 to $20 million? Maybe in some instances that makes sense. But this opportunity value acts as a threshold, a guideline, like guideposts as to like what should you expect to spend. It also allows you to then strategize when you look at, okay, we want to win in North Carolina. What are our options? If you want to be a sponsor of the Panthers, great. You want to be a tier one sponsor, cool. 2.8 million as a kind of general bucket, and we have obviously a low and a high end to that as well. But for that investment of roughly $3 million, you could actually get involved with probably several other properties. Of course, it's not perfect because there's activation dollars and other considerations, but it gives you kind of a tool to start to work with actual data that tells you roughly what you should expect to spend or to assess what you're currently spending. Are we overspending, underspending with the different properties that we're currently engaged with? And that's where this has been, I think, a very helpful tool.
good.
Okay, so let's get into bottom-up valuation, and I'm gonna get to some of these questions as well. So we've got now a marker, right, for the Charlotte Hornets. We know their fan base. We know essentially what, at least our perspective is based off the fan base and our metrics, what an opportunity or a tier one opportunity value looks like, what you should expect to be spending and a range there. Now the question is, okay, how do we build a package to deliver against that value, which we believe is the right sequence of events. Let's establish what we're worth based off of our fan base and our ability to deliver impact to brands who are sponsoring us. And then let's figure out how we build a package that's worth that amount, as opposed to often what happens is we just start with, okay, how many assets can we just layer on top of one another and what are those worth? And okay, that's what we're going to charge for. So we've taken a bit of a step in between to set the stage and try to figure out exactly what that investment should look like. And now we're going to try to back into, okay, if 1.2, 1.3 is the number we're targeting for a tier one sponsorship of the Charlotte Hornets, what assets are going to add up to that amount to ensure that our strategy as we go to market and our valuation is bulletproof, or relatively speaking, bulletproof? We've got the consumer context, the opportunity value, and now we're going to show you line by line transparently what every asset is, how it's been valued, what it's worth. Once again, this is like we're showing you our approach. take your shots. We encourage it. And we hope that other agencies will do something similar and open up kind of the kimono to how they do it. So what we do when we work with any property or brand that has a partnership package that they want us to value is we essentially take all those assets, we distill them down into four key buckets. There could be 25 buckets. Are these the right four buckets? That's a whole other conversation. But there's a reason and there's a method to our madness. So we chunk them out to media-based assets, in-venue or event-based assets, content and production, and then hospitality. Sometimes in the world of charity, we'll add employee engagement or we'll add community in different buckets that make sense. But ultimately, we always have these core four. Now, the reason that we do that is because we know, generally speaking, a brand that is focused on consumers and driving outcomes with consumers is going to target roughly like 70 to 80% working dollars to 20 to 30% non-working dollars. Neil, if you can just go to the next slide. And what that allows us to do very quickly is to say, based off of the assets that are being offered and how we value them, what is the asset mix? What does the package look like? If we're seeing that, things are skewing towards the non-working dollars, then it's a question or a conversation of, is this going to deliver or should we optimize the asset mix? Some brands will say, well, our objective is awareness, and that's not just in the building. We really want more media assets. It also allows us to play with and see what is the optimal asset mix to deliver against the brand's objectives. So not the be all end all, but certainly our approach that distills and makes it a lot easier to basically understand and synthesize how many assets are being offered, what are they going to help deliver, and how does that work out from a composition perspective. So when it comes to then our approach of how we measure media-based assets, and then we're going to talk about in-venue or event-based assets, we do use for our bottom up for media-based assets, CPM. We do, and why, and should there be a new metric? Like, we're all for a new metric, but the reality is that the media industry is a lot further along than the sponsorship industry, and the alternative that brands have is to go by media. So why not use the common currency that exists for now as a way to understand what the value of those assets are that are media driven? So what we do is we use baseline media spend based off of the market, based off of and that's not just Canada, but it's like local to the markets that we're actually valuing a deal in. We use those baseline metrics across, broadcast, radio, digital, social, you name it, as they're evolving based off of, available data that's out there, based off of what people are paying for media. And then what we do is we apply premiums to the CPM. And we apply premiums based off of first the exclusive content access. You can't just buy into the Charlotte Hornets, for example. You could try to buy around it. It's not going to work nearly as well. But brands that are sponsoring the team or any other team or property want that exclusive access, right? They want to be a part of that story. And that's really sorry, Neil, could you just go back one sec? That's driven by, the strength of the fandom for the property. So the premium element that comes with that and how we layer on that kind of, if you think about a waterfall chart that we're building upwards, we've got the baseline media spend, we add premium for the exclusive content access, and then we add premium for the proximity to the field of play or proximity to the actual celebrity, influencer, athletes, the most impressionable, the strongest at delivering kind of that brand value. So if you are on the jersey versus on the court, there is a different premium that we apply to that. And that's how we get to our CPM. So we have a sliding scale of CPMs that are driven by these factors that we can literally chunk out to say a music property is going to have a different sliding scale than a sports team. A charity is going to have a different sliding scale than a comedy festival. So we've got that broken out so that we can look at it along a ladder with consistency and say, this is what it's worth in this particular instance. So if you look at the example of how we would break that out or what that means in this very simple example of the Charlotte Hornets and how a CPM model would work, you've got Geico on the left-hand side, you've got Novant Health and Time Warner in the middle, and then you've got, Beastables and Jordan that are on the jersey. Well, I think it's fairly straightforward for us to say in a conversation that the CPM is going to be higher as you move to the right of this page. CPM is going to be lower on the left side of this page. And this is all based off of the impressions that these assets and these exposures are going to deliver beyond, obviously, inside the venue. We'll talk about that in a second. So we're building rationale to say you're working with us because you want access to our fan base, and that is a premium offering. If you just wanted to buy media, go buy media, and it should be cheaper than working with us, and that's fine. But then we're building rationale and credibility and saying that not every one of these assets is built the same or offering the same value. We're building that premium based off of where it is, how it's located, whether it's on the floor, whether it's in the stands, or whether it's on the players themselves. So when you look then at the event or in-venue assets in our model, we always use this example. So the traditional view that we've seen is, let's assume 100 people walk into a venue, it was a sports venue, a music festival, doesn't matter. 100 people walk in and there's a poster that features a brand. The general or traditional view would be, well, 100 people walked in, there was a poster. Those 100 people walked around the building, probably saw the poster 4 times. So that's 400 impressions, and we're going to apply a value to that. It's just not true. Like the data does not support that traditional view or approach at all. Many people will not see any of those assets or have a quality of understanding of that asset or a quality of exposure. So what our approach is, we say 100 people walk into the building. We first discount that number of people based off of the asset's viewability. A bathroom poster is going to generate a lot less viewability than, a marquee sign that is neon and lit up and digital and so on and so forth, right? So we factor that in, and that's not just based off of a perspective of what we think the asset's viewability is. It's driven by the data that we have that supports, because we've measured thousands of assets and we know which assets are able to best deliver sponsor awareness. So we discount it once. Then we discount it a second time based off of the quality of the exposure. So this is when we look at a bathroom poster as a static thing that is like 2D, and obviously there's not much there to do. A brand ambassador sampling experience that's happening on the concourse level is going to be far more dynamic, far more capable of delivering the outcomes. So converting people from being aware of it, seeing it, and then actually taking action from it. So we take those 100 people, we discount them twice based off of the asset that we're looking at, and then we know what the quality exposure population is. We apply a cost per contact, which is really rooted in the world of sampling and XM. And that also has a sliding scale. A bathroom poster's cost per contact is going to be 50 cents, and a dynamic brand ambassador experience where, your sampling is going to be worth 450, right? So we have a range once again by different property type so that we can actually show you specifically in either example the number of impressions that we think we're going to deliver through the media assets, and what they're worth and why, and also the number of contacts and quality contacts here from an event and a venue perspective that you're going to be able to achieve, and then backing and showing you exactly line by line what those are each worth. So not perfect, and we're going really quickly, but it gives you a sense of, if you're in the venue, there's a lot of different assets, and we're going to essentially assess every single one of those assets based off of the viewability and the quality of exposure to get at what is that quality audience, and then apply a cost per contact to them. Now, we're already at 140, and we want to obviously have lots of questions or time for questions. So when we collapse all this data in our approach, we can then start to show you what the value is by bucket, right? We can show you what the mix is, talk about working versus non-working, and ultimately the output, which I think is a huge part of this conversation that we're trying to encourage people to have, is it's not a black box anymore. So when we approach valuation, we hope others that are doing the same thing in the industry, it is line by line. Here is the summary of the deal. So Neil, if you don't mind going to the next slide, essentially what we have in any of our valuation work, we will have all of our inputs, which come from the market and from the properties that we work with or the brands that are showing us their deals. We then have an itemized line by line, every single asset that is a part of the deal. And we've got a talk track and the rationale that says how we valued it, the CPM, the cost per contact that we've applied to it, the viewability or the quality of exposure that we've used to get to that quality audience. Everything is line by line, so that if a brand, an agency, a property wants to go and discuss or challenge a line item, we can have an informed conversation and we're ready for it. We're not always going to agree. Rarely will people agree necessarily, certainly off the top, but it allows us to have a conversation that's rooted in at least a defensible approach. And then to talk about, are we off by 5%, or are we talking about being off by, 25%, in which case it's probably a bigger question about whether the deal is likely to happen or not. All of that data, though, funnels into what you see here, which is essentially our master summary sheet. And in this master summary sheet, we show you essentially line by line what the sums are for each of those core buckets, what that totals to from a value perspective. And then what we outline is the total value relative to the total investment that you're requesting or that is currently being made. And what that allows us to do is to get to what we call value to investment. So much like the 3-to-1 or 2-to-1 or wherever the hell it was, wherever it was created. Our stance is, and it's very transparent, we'll say it here, and we say it all the time to brands or properties or agencies, doesn't matter. Our stance is 125 to 135 to 1 is a great deal for everybody. You're getting a quarter more for every dollar that you spend. And we believe that that is a fair deal. It means that a brand isn't going to be rushing to run and try to find a new deal that's going to deliver more value. It means that properties aren't being taken advantage of and aren't just like throwing, unnecessary assets at you, and that they can then go monetize and commercialize those assets elsewhere. It's a fair deal where there's not much risk on either side. Rarely do we see deals fall within this exact range, but why we work with a lot of brands and properties is to try to get to a place where the deal can start to make some sense. But if we just assume or take these arbitrary 3 to 1s, 5 to 1s, we've heard it all, I'm sure you all have too, as like gospel and as what we're going to target, like we have to change the conversation. We've taken a stance and we've put this kind of stake in the ground of 125 to 135. That's where we want to be. That's a good deal for both sides. We encourage people to take their stance, and we think the more that we can have conversation and be transparent with what those guidelines, those thresholds look like, the better off we're going to be as an industry to get to the right deals done, and more of them, hopefully being done, and sticking around. So that's our approach, kind of 1, 2, 3, from sizing the property all the way through to the top-down valuation to the bottom-up valuation, and how we approach the world of valuation itself. And then we'll leave you really quickly, 5 minutes or so, with some what abouts, what if, some scenarios, some of which I think have come up in the chat. And then we'll get to questions. But I'll throw it to Neil to start kind of ticking off some of these scenarios that we often hear and that are a little bit like edge cases.
Okay. Yeah, we're going to get through these quickly. Yes, there's been a lot of information shared. I think that one of the biggest takeaways at this point should and could be that it is valuation is and will be in art and science type kind of formula, but there's far more science than is known for most of the time. And so hopefully we've proven out that we do have a science and that there is a science to our model in addition to the art. So what about arts, music, entertainment, and charity properties? How do you value those? How will those compare to sports properties? We value them in very much the same way, but we take into consideration that they are different from a timing perspective. Many sports properties are months, many music festivals or festivals in general are a weekend or a couple of weeks, and awards show are typically one evening with a little bit of a kind of pre and a little bit of a post. So those are things are all taken into consideration in our model, specifically again when it comes to number of people and sustained impact or sustained awareness and how that's established and developed. Outside of that, the model, the system is the exact same for a reason so that it is transparent and comparable. What about expansion teams, leagues, or events? How do you account for those? Again, from our perspective, it comes back to people. Prior to, we ask people about predisposition to follow, and we've measured many, many, many inaugural before they happen events and then post once they've happened events. So we do have a rationale behind what people and propensity says is going to happen versus what will actually happen in year one and then going forward year two, year three, year four. But we will always continue to track those things and apply that to the modeling.
Just quickly, because there was a great question about like what's the process for a one-of-a-kind event like a Tyson Paul fight. So similarly, like building on what Neil just alluded to, we would be tracking that event leading up to. We would track that event at the point, obviously. But if you're in market before and you're selling against that event, we're obviously helping build essentially the estimates and the projections, but they're rooted in fact. They're rooted in other properties, other events that we've measured that have been there before. We're not saying that that's a perfect fit, but it's a lot better than guessing or a lot better than just arbitrarily saying, well, we think it's going to be worth X. And then of course, that's just to support the top down valuation. Then we've got obviously the asset side that comes in afterwards. And we try to then ensure that those things are supporting one another. But it's a great question because there's a lot, and especially now more than ever before, there's a lot of new properties that are obviously popping up and new opportunities, new events that we can still apply the same science to. Couple of other things, then we're wrap. So what about business back and value in kind? We kind of like jumped over it in our assessment. We do value business back and VIK. Obviously, those are important elements. The reality and why we didn't really talk too much about them earlier is because they're so case by case. It depends on the brand, the category, the stakeholders involved. People will often talk about these massive deals that are, approaching $1 billion over the term and say like, how the hell is there any way that Scotiabank or crypto or otherwise are getting the value? I mean, there's a lot more than meets the eye, right? I don't know what's in these deals. We've not looked at under the hood of either of them, but I can bet you that there would likely be some business back elements that are probably driving a lot of the value and why those commitments were made. So they're absolutely important to factor in, but they are case by case. So it requires a bit more of fine tuning. The world of beer will look at, profitability by hectoliter. The world of, beverages will look at, or soft drinks will look at the number of cases that pull through, whatever may have you. So it takes a bit more of like fine tuning to get into that specific business to understand and to build a model that accounts for that. Next, we've got B2B or hospitality focus, which I think was perhaps another or sort of edge of another conversation or another question that came up, which was reach into different social demographics. How does that involve in valuation? I think it's a great question. So what we would say is that like this isn't directly related to the question, but sort of tangentially, B2B or hospitality or high net worth or any targets that are frankly more difficult to connect with or to reach and to break through with, we have a different sliding scale of CPM and CPC. So we do have that. We do value those, but they are different because they are more difficult audiences to reach. So absolutely is something that needs to be accounted for. It isn't the same as just trying to obviously connect with consumers. And so it requires a slightly different scale, but the approach is the same. And that's, I think, the consistency across sponsorships and being able to say that we measure these things the same way so that we can be objective about what they're worth and what we're getting in return is really, I think, a huge win for most organizations that aren't yet maybe doing that. Neil?
Okay. What about employee attraction, engagement, and retention? Again, similarly, we value that, and there is value in that. All right. When you partner with something or somebody that your employees get behind and is passion for, that's going to mean something to them. It's going to mean something to their satisfaction, and there's a way of valuing that as well. Similar model, similar approach, different outcomes when you look at what we're trying to drive and different behaviors when we're looking at what we try to drive. But there's a value is still associated with that behavior. It's all about assigning the behavior and what it is, and then ensuring that we're applying that same model and rigor to the model when we come up with the value and the opportunity value at large. What about team performance? I spoke on this. I'm not going to speak on it too much more. Look out, everybody, for the blog that's coming. It does matter. When you look at teams that are not performing as well than teams that are, their sponsorship impact potential is not as strong as the ones where high-performing teams come from. If you look at a team and you track their trajectory of not only performance, but then engagement and impact, you will see a correlation with as on-field performance goes down, so too does engagement and reach, so too does impact, so too does value at that point. Not in every instance, there are winners still when teams aren't performing as well. Read the blog to find out what they're doing. But this is also where performance-based comes into play or can come into play. If a team, puts in again that agreement that if we win or if we, win the Stanley Cup, go all the way, whatever it is, there's kickers and from that perspective, we're seeing a lot more of that happening because there's recognition of this point that we're talking about right now. So I'm going to throw it very quickly to Adam just to run us through four more points, and then we're going
Yeah.
to probably go
Yeah,
to
let's do
questions.
questions. We can skip this for now. Let's do questions. I think there's some
Perfect.
amazing questions. So one that got seconded, and I appreciate people doing that. So the question, Adam, if I'm gonna articulate well, so is reach into different social demographics involved in valuation, i.e. race, gender, economic background, or actually physical location, i.e. NC native who now lives in Dallas or Vegas due to work. Like how is that factored in? I don't know if I'm fully grasping it, but our approach would say a couple things. So one, when we do our top-down valuation, there's a lot of different ways that we can slice it, right? So properties will argue at times that they're either a local or a regional or a national or an international property. Our data set allows us, and the way that we go about collecting data allows us to look at every one of those layers. So there's a valuation that we're doing right now where we're looking at a property and we're building out essentially a valuation model for them that looks at what are they worth when we're looking at the local kind of direct radius versus the regional, which is obviously much bigger, and then the national, because there is a national play there. So I think that from a location proximity is certainly a big part of our top-down valuation, where we can help people understand across kind of different geographies and beyond borders, like what is the total fan base, especially for, in the world of global sponsorship and all the properties and events that are out there. How do we look at the value of different social demographics? We don't. I would say like the our approach is as Neil walked through with the Hornets, we look at the demographic composition of the fan base to help people understand, is this on target for you? And then we also look at the categories, or like, are your category buyers in this fan base? And then we go into, the assets themselves. But I wouldn't say that we tie a different CPM or a different CPC based off of ethnicity or gender or age. Those are kind of more earlier on in understanding the property's strength. Neil, did you have something you want to add?
Yeah, and we would and can size that audience and value just that audience in terms of what it's worth based on the property's delivery of that audience. Again, it's not going to answer for the full picture, but we do always look at whether or not the property is able to deliver that audience for your brand, and in a meaningful way. So beyond just that reach, will they be impacted by a partnership? Are they passionate about it? Is there momentum in it growing? So we will always look into that as a kind of first blush, for whether or not you should even consider this property, regardless of what the money is.
Another question: how do you value intangible assets such as category exclusivity? I love this question. To be honest, like we think that category plays a huge role, but ultimately, the categories that spend the most are going to find their way to the most premium top tier assets. And we think that there was, of course, like an approach, and I'm not suggesting it's the wrong approach, but there was an approach of like having a multiple based off of the category. I don't know how you defend that. Personally, I'm sure that somebody here has a great defense, and I'd love to hear it. But our approach is, as we've alluded to, is we look at the fan base and the value of that fan base. We are able to identify the value of the fan base to that category by looking at the subsets, and is your category buyer, competitive buyer, present. And we use that to essentially build what is the value of a sponsorship with that particular property. But once again, similar to like the perspective that we take on IP, like having a line item as this category exclusivity and like $2.5 million, I'm like, I'm already paying you for the partnership. Like, why am I paying you again for category exclusivity? And I think that that's a slippery slope, and one that's becoming, tougher and tougher to justify or to defend for CMOs, for CFOs who ultimately have to sign off on a lot of these major deals. I'm not suggesting that you don't want category exclusivity, but I'm saying that should probably be included in investments that are beyond a certain threshold, as opposed to line items that leave you exposed to risk, and people asking very, I think, legitimate questions. That's at least our perspective. Another question we got: do you factor in saturation or amount of all those visible assets in stadium, for instance? Do you want to take that one, Neil? Or?
Go ahead. I got
Okay.
one. I'm waiting on.
Okay. So yes, as we kind of alluded to in terms of the way that we break down, particularly like in-venue assets and discounting, it's based on the asset's ability to deliver either awareness or convert awareness to impact. The one thing that is nuanced is that our modeling, in what we've shown you, is based on like the benchmarks that exist across the industry. With many of our clients, where we're actually measuring the actual impact of their sponsorship in market, we can actually use the real facts that we collected from that market and from their assets into the model. And that's where you get, I think, really interesting, kind of sophisticated, we're covering kind of all angles. So what we use for, this type of approach and what we're sharing today is more industry-wide benchmarks, but we certainly can dive deeper, which allows us to get to specifically with, any particular property and the brand sponsoring it and the assets that they have that are visible. Are they breaking through? Are they delivering impact? Which just allows us to get even deeper into the weeds of like what's working, what's not, and is it delivering ultimately value back to the business?
So we got one: sponsorship is intended to allow brands to connect with their target audiences through their passions. Have you started to think about how, as an industry, we can start identifying the value of that connection? So the answer is yes, and that comes back to first and foremost the metrics we have, which isn't just about reach, but it is about passion that people have towards the property, and then impact of a sponsor, which goes back to and ties back to connection or potential connection people might have with that brand who's associating with something that they're passionate about. The other thing that we often do in valuation, but also in just defining an opportunity absent of valuation, is we start to ask questions specifically about the property in relation to their attributes and about the brand in relation to their attributes. So we can see if there's an authentic fit or connection between the two. Because every property is going to have two, three, four pillars, things it stands by, things, reasons for why people are fans of that property. If one of those doesn't mirror what the brand is out there trying to achieve in the marketplace, it's going to be very tough to establish that natural connection. So that's something we always look for. Again, absent evaluation, even before we say how much something's worth, is it the right opportunity for your brand, regardless of what it's going to cost you? So the answer is yes, we do it. The industry is heading more in that direction because they're recognizing the benefit of sponsorship is to do that versus more traditional marketing tactics, which is, really ultimately all a lot of the time about reach. So great question and thank you.
Hey, one more
I know
question,
there's
then we'll
more
kind of,
questions.
yeah,
Go
well,
ahead.
one more question, then we'll wrap up. There's a great question about how did you go about starting a valuation from scratch for a smaller organization, say an annual community event, 10,000 attendees, or a minor sports league. So I think similarly, like when we don't have data on something because it either doesn't exist or because we do have some gaps. Obviously, we've got like 850 properties in Canada, we've got probably 750 in the US. And we've got obviously global as well. But if we're missing something, we use the same methodology. We go collect the data so that we can backfill. And what that allows us to do is still compare to other properties. So that's one thing that we do to ensure that we're still getting accurate data on even smaller properties. We'll go and survey in that local market. Or if budget is not there, we'll literally look at comparables because we've got lots of
Right.
comparables that we can leverage to kind of build essentially the story and use, proxies that are rooted in data still. We just disclose that they're proxies, right? And I think that that's can oftentimes be well received. I think for a community event with 10,000 people, as an example, like there's a ton of value there. The question is not, well, I mean, one question is what's currently being done or delivered or what assets are currently being offered. The next is, okay, well, what are some of the other assets that we could be delivering that are probably low cost and high margin and high value to our clients? So I think it's always the balance of what are we doing today and what are we willing to potentially do tomorrow to, make the deal more valuable, to add more value to our partners, but also to drive the total revenue that we can bring in. But if you've got 10,000 people coming out to an event, I mean, there's value there, right? You're creating value, you're connecting with a big base of people, and we will work with you to essentially try to optimize what that package looks like.
Yeah, and we've learned many, many times that a small event in a small city is a big event. Big event as defined by it could only be, not only, but 10,000 people, many of whom which are going to be more passionate and more likely to be impacted by a partnership just because of that intrinsic following for that event and festival. So often you'll see the value go up a little bit from an opportunity value because of how likely they are to be impacted. And we've seen it so many times that we can model based on what we've seen in like type events in that area without having to go, perhaps, depending again on the size of the property, interview people or survey people on the market.
So to wrap things up, I think once again, we don't have everything sorted out. We don't have it all figured out. I think we appreciate one, you guys taking an hour of your day to join us and to ask questions, to be a part of the conversation. I think the more that we do this, the better off our industry is going to be, and the closer we'll get to a place where it's like it's a marketplace and people are buying things for what they're actually worth and the value that they're delivering. We certainly believe with the way that the industry is trending that that's it's coming. And so getting ahead of it, ensuring science is backing the way that you're valuing your business or the assets that you offer, the way that you're making those decisions is only going to help and make you, future proof in the way that you go to market and the way that you're transacting. And then Neil, I'll let you kind of close things off.
My close is my sale, which is if you want the data at your fingertips, it is cost effective to log in and subscribe to our platform for one market. You can create your own opportunity value. We can help with that, but the data to do so and compare is all there for $948 a year. Scan the QR code. That's my leave behind. Look out for the blog on field performance because that's coming soon too. You should also check out the one we recently did on Bud Light case study in their partnership and sponsorship performance and bounce back ish. So lots of good content to be shared. We will be doing another webinar shortly. We'll ask you again which one you'd like to see. So we're not just talking to ourselves, we're delivering something that is needed in the industry. Thank you all for attending. Thank you all for supporting, and we will speak to everybody very shortly.
Great day, everyone. Thanks again.